How's it going, everyone? Welcome back to the show. Today, we've got Stewart Heath, who has been in our world and is just rocking out. Recently raised $2.8 million, really without sharing much about the deal. So hasn't yet sent out one email, so he's almost fully subscribed. We're going to break down how he did it and some cool stuff about pref equity as well. Stewart, welcome to the program.
Hunter, always great to be here. Thanks for reaching out and having me.
Super excited for this interview. Again, I got to tell you, it's been so awesome to see you just kind of keep putting one foot in front of the other, and now it's really starting to crank up. Your business is doing really well, and it's been awesome to see partnerships, deals closed, capital raise, and I know a bit about your business. I just feel like you're putting it to really good use and good assets. So, first of all, congratulations, man. I know
Thank you.
it's never as easy as it seems from the outside looking in, but I just got to say it's been awesome to watch.
Yeah, yeah, it is. Slow and deliberate has always been our thing, and so yes, it is paying off, and it's we've reached the point where we're having fun. So
Man,
it,
gosh,
it
that's so good to
it
hear.
takes a while to get there.
Man, you know what though? There's people listening to this right now that are like, it's just so hard because it is hard.
It is.
But if you just keep going, it will get to a point where you're like, was this ever hard? Like, was this ever hard? Like what you're currently doing right
Yeah,
now, right? Like if you're trying to raise $500,000 right now and it's just painstaking. If you keep going for a couple years, raising $500,000, you'd be like, was that ever hard? Because hopefully you'd be on to bigger and better things. But if you can,
right.
if you can just keep going, you will put your current pain points, challenges in the rear view. And by the way, when you start going from 500,000 to 5 million, or in this case from 300,000 to 3 million, it's basically the same amount of work, but you get an extra zero. So, like on the back end, which is awesome for you, your family, and also your investors. So,
Yeah,
let's talk about this. I've talked before regarding this concept of like getting commitments so that you feel much more comfortable going under contract. And it's actually something that I get a lot of pushback on. People don't understand the technicality of it, people can't really imagine it. Are you, using a template of a deal? Can you talk about the specifics before you actually have it under contract? Rather than me say my version, I just want to hear your perspective on how you can like pre-raise for a deal and then you get this crazy pronounced result where you raise it really quickly. I'm going
yeah,
to put the ball in your court. How do you do
sure.
this?
Um, Well, what I think it really is building relationships. So yeah, I understand the complexities of perhaps compliance and pre-raising, that's not what I think that we've done. I'm talking to my existing business relationships who are always calling me, wanting, what have you got in the pipeline? And I tell them what I've got in the pipeline. And sometimes, and we've been very, very active making offers this year. Only got one thing under contract at the moment, and it's what I call a very balanced market. There's a real struggle between buyer and seller, which is the way it's supposed to be. And so I'm talking to people about the economics of the deals that we are trying to get under LOI or might have just gotten under LOI. And so they're very informal conversations with people that I either know or are already doing business with. And so I don't worry too much about the compliance side of that, but they're just a conversation. I didn't ask them for anything, and I'm just telling them what I'm seeing in the marketplace. It's the kind of conversation that should be going on between business people all day long, every day. Uh, what has happened in our world, and I've been with you for a long, long time, and you've taught me a great deal. Um, but we've always sort of focused on the boring cash flow deals, and we've stuck through that for from 21, 22, up to now. We just stick to that. And we've watched a lot of folks that are doing the multifamily value adds, and I'm not throwing any rocks at them. Nobody would have ever underwritten what happened with interest rates, and because that was crazy. But fact of the matter is that impacted a lot of investors and a lot of people in our world, and we've just focused on cash flow. I mean, and so almost all of our deals have a very similar makeup. And, I like to say that I don't care what interest rates are. I care what the gap between the cap rate and the interest rate is. And when you're dealing with stabilized, you don't have to worry about a whole lot of other variables out there. And so I'm just a CPA that's trying to put together a financial formula, type of a thing. So people have appreciated that, and we've gotten through this whole time without suspending any distributions, without having to make any capital calls. Knock on wood, uh, likelihood we are going to have a deal go sideways at some point. And but we try to keep them multi-tenants, so our risk is diversified. So so but the years go on, the more people I talk to, the more people that are interested in. Sometimes I'm calling them, sometimes they're calling me, because we're putting out a lot of content about what we see in the economy, and then that'll trigger somebody to pick up the phone and call me, "Hey, what are you working on?" Because we don't ever put that out on the website or in our newsletters or anything, but we do tell them that, "Hey, we're looking at a lot of deals." So it just starts informal conversations. And then, this latest one that we got, it's a medical office building. And just in conversations, before we ever even really got it under LOI, we had interest of well over $1 million on that one, on a $2.8 million raise is what it's going to turn out to be. Then once we got under contract, then we start getting a little bit more strategic, reaching out to people. "Hey, we got this coming. The cash flow is going to be X. The leverage will be this." And then we do it all over again once we get actual lending commitments, because we will initially underwrite conservatively, and then when the interest rate comes in or the amortization comes in a little bit better, that's another selling point, if you
Yep.
would.
Yep.
And we're just now this week, we're 2 weeks behind, frankly, but yeah, but we're just now this week starting to blast that to our whole list. And so our raise is going to be $2.8 million, and we got 2.3 committed, as we sit right here before actually officially launching the raise. Yeah, and in the midst of all this, we're also launching for our fund, and this asset will go in the fund. We got some other people who don't want to be in the fund, and so the fund will partner with them, and we'll walk forward with them that way. So that's really where it's come from. As we were talking before, this is just a journey of continuing to meet people and doing business. The first deal we did, I raised $1.2 million, and in that I had two guys write mid six-figure checks. So I had to fill in a few 25s and 50s around that, and it was a victory, and it was great. Those both of those gentlemen are still investing with us. But since then, we expand network, and we just honestly, I just spend most of my time on the phone talking to our investors about deals they're in and deals that we're working on. So it is, I boil it all down to, where I started. This is just about relationship and building those relationships, and which is hard at first, but once the relationship's there, they get harder to destroy. So
Yes. And you've done a very good job of creating that content that brings in new people, but also helps you stay top of mind for those existing investors. And so, like, this is a big unlock. Like, if you're the kind of person that's like, I don't really want to be out posting things or talking about the economy, I just want to do deals. It's like, well, how are you going to stay top of mind when your competitors are executing this kind of one-to-many strategy where they're just sharing their thoughts and beliefs? Now, it doesn't mean that Stewart never talks to investors. He just mentioned he's constantly having conversations. But the reason he's able to have those conversations, the reason that about half, if not more, of those conversations are initiated by investors is because he's constantly pinging them with relevant information, not spamming them, not being like 50 emails in a day of nonsense. You heard what he said. He'll wait until very programmatic points in the process to give justifiable touch points. So it's like, hey, we've got this like deal that I can't go into too much detail. Would you be interested in learning more? That will spark interest. Then the loan terms. Okay, hey, good news. We underwrote this conservatively. Then the deal's actually like ready to go, or you're launching it, which is about to happen. Okay, then additional layers. And those same people that originally made their interest of $1 million, for example, they want to see these updates as well. So it's like the more you can inject some of these one-to-many strategies in your business, the better. There's another thing you mentioned I think is really going to help you guys on this raise, and I know you've executed it before, this pref equity piece. Can you walk us through how the capital stack looks on this deal and where that pref equity comes into play and the implications?
Yeah, I avoided doing this for several years, and then I watch all my other RaiseMasters do. Of course, they're generally doing bigger deals than we do. So this current medical office building, $7.1 million deal. Um, it's a nice sized deal. It ain't a gigantic deal. So, but but the math on this is beautiful, and we did this on our last deal that we closed in September. Um, so to me, it's all about leverage, and the way I use pref equity, it's essentially sub debt, subordinated debt. So we'll have a bank loan at about a 65% loan to value, and then I like to stay below 80 total debt. So this pref equity group that raises money out of China and they have a particular thing that they like. They like to be they like to be under 80% total debt, including themselves. So they'll have a secured position. We paper it up as preferred equity, not as debt,
So there's no
which
lien
is
on the property. There's no
they're
foreclosure if there's a default.
exactly. But they are in first position ahead of the rest of the equity, and so we'll peg them in there. So on this $7.1 million deal, that class will be $710,000. They will get a preferred return of 10%. We'll arm wrestle whether or not they get an accrual for an additional two or three. But what that does is it really makes the returns for the equity people who will still get a nice 7% cash on cash on their piece. But then they'll get all the upside, and that the Class B will get all the upside and all the depreciation and all that kind of stuff. And that's who we as sponsor end up splitting with down the road, because the pref equity people, they're going to get their 10% return, and that's it. Period. And they're happy with that. And basically, essentially, by using more debt, we're enhancing the returns of the equity, but it's not debt, as you just said. There's not a recorded lien against the property, and there's no guarantees. They're just first in line, and they're getting paid accordingly. So it's essentially like mezzanine type debt in the M&A world. So
Yep.
that's been a very powerful tool. Again, I'm a keep it simple kind of a guy, and so but I watch other people do it, and I would just say, well, that's for larger capital stacks, but not necessarily. I mean, it really does goose the returns for the equity folks, and doesn't really stress the property cash flow wise, because we're still being conservative on the total outflows. So
Yep. Let me just give some tactical stuff regarding this because I've been through a lot of iterations of this. At ASIM Capital, the last deal we did, we debated doing a 10% pref, or it was just 10% quote current pay with no accrual. Tyler and I went back and forth. We actually did something where we had an 8% current pay and then a 5% accrual. So the net ROI to that investor, or AAR, average annual return, would be 13% because it's 8 plus 5. Based on the way the market reacted, I think that's probably too much. I think next time we'll probably do 8 plus 4, so it's getting to 12. But what's interesting about this is that when you play with this, let's say it's like a percentage of the capital stack, 10%, 12%, 15%. You can kind of use this as a way to reduce your overall cost of capital, and therefore pay more for deals. Now, you might hear this and go, why in the heck would you want to pay more for deals? Well, if you can squeeze out an extra $100,000 because you're reducing your cost of capital, it might make you more competitive and be able to buy more deals. And if your competitors are using this kind of strategy as well, and you're not, you're going to be at a real disadvantage, because unless you're going to be extremely aggressive in terms of underwriting, a lot of people that have a lower cost of capital will pay more for the same deal. Now, just to give a really significant example, in the past, when multifamily is heated up dramatically, you could hear stories about, oh, this group was going to pay 32 million and then the deal got bought for 42 million. It's like, how? Well, it was a pension fund. Well, why does that make sense? Because the pension fund's overall cost of capital is so low that they're willing to pay way more. Now, that doesn't mean that you want to be blowing everyone out of the water, but if you can just find ways to engineer a very secure capital stack, but to buy more deals, it's going to be better for you and your investors. Just something to think about. And one last piece about this, I'm getting a little bit technical, but if you can reduce the cash flow, you can have a justifiable reason. Like if the pref piece is 10%, if you reduce the cash flow to 8%, but there's a accrual, you could also have a justifiable reason to increase the overall percentage that could go to pref equity. But all of this stuff is a double-edged sword. You can tell from the way Stewart delivers this message and the way he talks about business and relationships. We're not here to just max out everything, but these are important tools that you should know about. If you don't, you're probably going to have some deals slip through your fingers. You don't want to do that, especially in this market. What are your thoughts on all that, Stewart?
No, I completely agree. And actually, that 8 + 5 is what we did on our last deal, because
Okay.
you and I had a conversation not too long before that. Oh, that's a great idea. So I'd already decided we would do pref equity, and then yeah, and reducing that that current cash to 8 actually incentivized. We were oversubscribed on that deal, which
Yeah.
was fabulous news, because the two previous deals that we closed in Q1 of last year, we didn't.
Mm.
Harvard Grace ended up making up the difference,
Yep.
but the pref equity actually helped make the economics of the deal work, so which made it more attractive to the equity folks, with a higher cash on cash. Yeah, it's as interest rates were coming down, people did not reduce what they wanted in cash on cash.
That's true.
Nobody's doing this at 5%.
Yep.
They want 7, 8, and 9. And so we try to start everything at least 7, with the expectation that it grows year over year, based upon the in place leases. So no, I agree with you. It does become a little bit more art
Yep.
than science, and you do have to be mindful as to not quote over leveraging the asset, because your safety valve is that equity sector. Yes, they're in it for cash flow, but in case there's a problem, that's who doesn't get paid, including the sponsor.
Yep.
I too have seen, I've lost deals to quote family offices, especially on storage deals where they're willing to come in and pay. I lost one last year. They paid a 5.8 cap. I'm just like, well, they have 100-year time horizon. That's
Yeah.
no reason to overpay. I mean, I just like, who are they? I
Mm.
just, I want to put my CPA hat on and go counsel them, you know. But they had some money to deploy, and their attitude was, well, we're going to win this bid. I think that's rather short-sighted, but
Yep.
those are who we compete against, you know.
Yeah, especially in that price point. Tyler and I were just talking about this as well, is that in that like $2 to $8 million purchase price range, you see some unique things happen where, and Tyler was dead on when he was talking about this, so I got to give him credit, but that's a very common place for 1031 exchanges to take place. There's a lot of families that have one, two, three, four, $5 million deals. And right now that doesn't matter. But my goodness, it's gonna matter again,
It is.
And so when transaction volume is down by 50%, 60%, 80% in some markets like Phoenix, I'll put it this way. If you have a business that facilitates 1031s, you basically don't have a business when the market corrects like that. But that's not the kind of thing that stays there. right? And so if you can buy a couple deals in that 2, 3, 4, 5, 6, 7, 8 number in terms of purchase price, in 4, 5, 6 years, you might have the situation where you have a 1031 buyer that's under the gun that has to select a property, and why not yours? And you get this really pronounced payday. Now, I
Yes.
know you're underwriting. You're not underwriting to something like that, but it's an interesting piece of playing into that market where right now people are like, oh, I don't want to buy that. Well, maybe they're not your buyers, but there might be some family that needs to place around 3 million of equity and buy a $7 million deal
Yeah.
in a timeline, and then you can kind of take advantage of it at that time. So,
Yeah.
Stewart, this is awesome. And I mean, we could go back and forth talking about this. I think I just wanted to, first of all, congratulate you as always. For the people that are interested, maybe they want to learn more about the space you're in, which is a unique asset class, or they kind of want to talk about the pref piece. How can people learn more about you and your business?
Best way to get with me is you can find my contact information at the website, harvardgrace.com. You can even get my Calendly link there. I still keep that out there because I'll talk to anybody about real estate all day long. So, and I do welcome anybody who wants to chat and reach out. So that's the best way to get me.
Cool. We'll link to that in the show notes page. Stewart, thanks a bunch as always.
Thank you, Hunter. See you.
Boom. Rocking out. I thought I